Good morning, ladies and gentlemen. Happy Friday to you all. The weekend's almost here. Now, if you missed the move yesterday on the market, it was a crazy day. We basically gapped down, pushed up, never looked back, and maybe you're wondering, is this move real or is this move fake? And what generated it? So, without further ado, let's get into the video to talk about why. So, as you can see here, we gapped down below our 200 daily moving average. I did say in the midweek update that if we printed a lower low of 393.12, then I would be looking for it to self-fulfill. However, the bulls stepped up and proved me wrong, and I'm willing to admit when I'm wrong. They came in, they bought the bottom, they pushed it up higher and never looked back. We never actually made a lower low on the day. We formed our low, higher low, higher low, higher low, and we literally never foamed a lower low on the day. All we had is constant buying pressure. If we look at the 1 hour on the S&P 500, we start to see something that we haven't seen for a while. So if we look back on this region here of buying and selling, what is very, very well distinguished? Large selling volume, large selling volume, large selling volume, more large selling volume. We're starting to see this buyer step in with volume. What do I always preach? Volume confirms price. If there is no volume behind the move, it's going to reverse. So now this is sending off warning bells that we may be possibly getting a reversal. However, it's a possibility. It's not a guarantee. We have to look at all the other indexes, yields, and the dollar and VIX to see what other things they're telling us and maybe understanding why we had this move. Was it legitimate? And where we could be going from here. So let's go through the SPY. We had our move. We broke down, had a failed breakdown. This is considered a failed breakdown. You break down the key support, you gap back above it. That is a failed breakdown. The bears failed to hold 393.14 on the day. So we powered up through our 50 daily moving average. That's check number 2. That was resistance. It didn't even think twice when it got there. We basically went straight through it. We had a little bit of consolidation in the region right before, digesting the moving average, and then on the close, boom, right through it. So that's bullish. That is showing, okay, we held where we expected to find buyers, even though they had the ability to buy this price several times this week. I really am surprised that they stepped in and bought it back up, and then we continued higher. We came to our second resistance, pushed back through it on the close. However, we are sitting right at this resistance now, should become support, but we have to see how it interacts. On top of, if we look at a zoomed out view, we're heading towards this consolidation area here, where we have 399.17, which is our 50 weekly moving average that I've been talking about till I'm blue in the face, guys. This is where basically need to get back above to be long-term bullish. I do believe it's going to be a significant point of resistance, but I'm truly wanting to be proven wrong. And I'll explain further down the video what I see happening to the market, but I'm just giving you the key levels so you can make your own informed decision of how this trend plays out, because I can't be there for you. This 399.17 level is super, super important. It is the uptrend that we broke down. It is the convergence of around 400 and the 50 weekly moving average. We're going to hit this area at around 11 o'clock today. So when the market opens up, it's going to have about 2 hours of trading before we converge upon this area. And that's when I would like to see the decisive break of this area or rejection. We may be consolidating around that region until 11 o'clock. But when we at 11 o'clock, I'm going to be looking at this to see if we break above it. If we break above it, come back for the retest hold, I'm definitely going to be looking for a more bullish scenario. If we're failing to hold, then I'm going to be looking for more downside. First target, 397.10, which is our 50 daily moving average, and then probably 393.12 as a secondary target. So if we go out to the daily, just to give you a little more context, you have a massive bullish engulfing candle on the daily. You ate this candle alive. You broke through 2 resistance levels, nearly tackled a third. And that's a strong move. You had volume supporting it. On the day, it was less than previous. However, you're starting to form that reversal pattern there. So it's definitely bullish. Now, like I said, if you break above 399.17 and close above it, then you're looking at probably coming back up to this area of 405 to 403 to fill this gap, and then possibly even filling the gap here at 408 to 407. And then as a really runner target, once you fill that gap, probably 417.76, which is our high from previously. So definitely areas that we have to be looking out for if we break 399.17. If we fail to, then we're looking at, like I said, the two targets, 397.10 and 393.12 on the S&P. Let's jump over to the weekly real quick just to give us a larger time frame picture. On the weekly, are able to get above 319.17. We may be forming a hammer on the week if they manage to push it back above 401. If they manage to do that, which you could get a short squeeze. If you get past 399.17, you have a very good chance today of having a short squeeze. And it's going to be massive because so many people are short side bias in this market. Even I was short side bias in this market. And I saw is bears failing to break us down lower. You had 1, 2, 3, 4, 5, 6 opportunities to do it. You just couldn't. And this is reminiscent of what happened back here. You failed to break the level. You found good news that you want to rally on, and you pushed up higher. Do I see that possibly happening here? Yeah, I could see above 399.17 that actually happens. Form another bullish candle, close out the high, form a hammer on the weekly to then push us higher, trying to reclaim these levels up here. If we fail, like I said, you got the two lower targets, but it's all going to matter about Friday's close, which is the close of the week, and it is the close of the day, and possibly a trend reversal. I want to see volume come in. I definitely want to see a high volume day. It's going to be Friday, so most likely going to see a lot of repositioning. So let's take a look at the positions I closed today just to give you guys a transparency of what I saw and what I did. I didn't like the market, how it was acting. I closed out almost all my positions for a total gain of about $457. Today I made $225 roughly. Yesterday, closing off these positions. These were a couple of weeks outdated positions, but they were almost 80% of the profit with this big drop. So I was happy with the profit. I said, I'm going to take the profit run. You don't go broke necessarily by taking profit. And I wasn't seeing something that I liked in the market. When you have those situations, you take profit, you sit on your hands and look for a new entry. The way the market was doing, I was like, I want no part of this. It's looking like it wants to come back up. Second we crossed back above the 200 daily, I was like, nope, get out. See you. I'm out of here. Remember, you can be wrong, but you can't stay wrong. And I thought we were going to break down lower. I was wrong. I didn't stay wrong. I closed my positions, and now I'm either looking for a higher point to short the market or maybe possibly run it up. I'm a little more bearish side skewed, full transparency on that. So I'm going to be looking for more shorting opportunities than longing opportunities, just because looking at the overall trend, and we're going to get into that with the news that came out today, what sent us higher and what happened after the markets close, because that are making futures go red right now at the time of recording this video, which is 7 o'clock at night on Thursday. So going back, reiterating the levels, 399.17 is your resistance. Break above that, hold bullish. Failed to break that break below 397.10 is going to be bearish, and then probably retesting the 393.12 level going into next week or even today. If we look at the NASDAQ has been lagging behind S&P and Dow Jones recently. We failed to break down again, similar story to S&P, broke below 289.89 and just powered up through the day, having a nice 0.83% day after being down nearly 1% on the day. Definitely a very powerful move. The bulls came in and stepped up to the plate. I think NASDAQ's target right now is going to be the swing point high of 396.52 right before we get to the 50 daily moving average. If S&P is able to reclaim its, I do believe NASDAQ will be able to reclaim its moving average. Next, I want to see this 298.73 gap get filled. I want price action to go up there, get filled, and fill this gap, and then start tackling these upper gaps to be bullish. Really, all eyes is going to be on the S&P, because S&P is closer to its key resistance point versus the NASDAQ, and I would use that to trade the NASDAQ just because they're all so correlated. They're correlated markets. If NASDAQ breaks below 290 on Friday, then I'd definitely be looking more bearish side. Long-term bearish, I'll probably reinitiate shorts, even though we're coming down to the support level. This would be a dead cat bounce in my opinion, and we're just going to send right through this 286 and 284 levels. But I do believe that we have more upside testing possible, and I think that this is going to drop the bears. And that is, we closed outside of value on the S&P and NASDAQ. So we're going to come back, and we're probably going to be from the close, we're going to be about 0.39 to possibly 1% down on open on the ES, or NASDAQ. I would say the same for it. I'd be looking for either 0.68 or 1% on open. Again, what are gap downs for? For buying. What do we have today? Gap down. So we could gap down, buy, gap down, buy. You guys see the trend forming here that we need to take out some of these volume profile rotations, the POC, especially on the NASDAQ. If we go to S&P, we can actually get a little more for the people that trade that, some more accurate price targets. I don't think this POC is going to get hit at 394. I think we take out value area low 396.78, so that's at 0.4 and then 0.6 on the NASDAQ. Targets that I would say for the gap down, NASDAQ's target is 292.62. In post market, we're pretty close there, so I wouldn't be surprised if we see maybe a little more red or open around 8 o'clock today, or we go into open slightly around that area and then push up higher. I really would not surprise me, especially with some of the news that came out. On top of the Dow, we have strength in the Dow. If we look at the daily for the Dow Jones, it's just pumping. It bounced off its 50 weekly moving average, gap down below for a second and pushed up yesterday and just continued today. So definitely showing strength in the Dow. Dow's got a long way before it retakes this upper trend line here that it was, but it definitely has the ability to reclaim this 50 daily moving average, and that's where I could possibly see short side potential. You do have some price action here that you want to fill in this minus development area, so definitely potential. Now, what are the other things we got to look at? Yields, dollar, and VIX. So let's go through this real quick. VIX, dead dog. That's all I'm going to say. You bust out, failed breakout, got rejected off the 200 weekly, which is super resistance. Broke down below, you're probably heading back down to this trend line. And that's why I'm saying you could get a nice short squeeze in the market, or we could find support around this region here of the $19, $18 range where you previously had. Everyone's dumping VIX today. However, VIX really hasn't been the same since 0DT options. It is an indicator you need to look at, but you don't necessarily need to be completely reliant on it. To me, the way I look at how Friday can close is based on the option positioning in the market. And if we go to it, so I'm going to go to S&P real quick here, and we're going to look at the open interest. The open interest is what's going to tell us who's holding these contracts through open. These are expiring tomorrow, and which side has the opportunity to get burned more than the other. So quickly looking here, 401 to 394. Why is that important? If we take a look on the S&P, and what levels I was talking about, 394 is right at the 200, and 401 is above our 50 weekly moving average. Key levels that we need to basically hold to or be bullish or bearish. So the stage is set. Now let's take a look at open interest. You have 47,000 calls sitting at 400. Makes sense. That's a bullish area. If we look below here, some notable prices, 395 for the puts. And then you have an area of like 25,000, 22,000, 29,000 sitting between 398 to 400. Open interest here. So there is more ability to burn the calls than the puts. You have more money on the call side especially, but if we push down below, there is definitely not an incentive to burn these. There's more incentive to burn these puts. So honestly, you could get a 400 close where they don't pay out this 47K options here, and they only pay out the 23, and then they burn some of these puts to then even it out. So max pain probably 399 or sub 400 close, which would be slightly above the 50 weekly. So the perfect scenario, and this is the perfect scenario that I really would like to see, to be bullish. Break above the 50, you push up higher, everyone gets excited that they're going to get paid out, they slam it into the close right to 399.9, let's say. That burns your calls, it burns your puts, you get the bounce off the 50, you close back above it. There's your bull scenario where the market makers are happy. Bear scenario, you just slam right back down where you were. So where are we going to go? So that's the question that everyone has on their mind. So if we look at the dollar, what it's doing, you have a bullish engulfing candle on the day for the dollar, and this is on Thursday. Nearly bullish engulfing, could push up higher. Dollar basically said, I don't care what the Fed has to say, I'm just going to keep going higher. If we look at yields, 1 year powering up, breaking out, 2 year running like no tomorrow, 5 year running like no tomorrow, 10 year running like no tomorrow, 30 year running like no tomorrow. This is where I get super confused, guys. because this is telling me, especially with the 1 year, especially with the 2 year and the 1 year is just slamming it. 1 year bull flag, kind of faking out breakout, pushing up higher at the time of recording this video. 6 month, kind of just sitting there, not really doing much. 2 year, what the Federal Reserve follows, 4.89%. It's basically saying we're having a 5% federal funds rate priced in completely. This thing's gonna hit 5 and it's just chugging. So I really want to see a pullback on this if we're gonna be bearish, but I don't see any signs of it. You did have this hanging man candle here on Thursday, but Friday we're just pumping. Like there is no stopping this thing. So this is telling me one scenario that the market should go down. If we look at the dollar, it's telling me the market should go down. If I look at the VIX, it looks like a dead dog just died. So I'm getting confusing messages. If I look at the S&P, I see it powering above 2 resistance levels. I look at here, powering above 2 resistance levels. And the thing that I have to get across is we ran on news that may have not been news, but who cares? You broke above resistance levels. That doesn't matter. The news doesn't matter. The news is just going to take the market on the predetermined path it already was set on. And to me, you could have seen this kind of happening. You were consolidating downwards here in this region and you just had your nice push up. So to me, there could be continuation here. Now let's look at the news to give us maybe some insight of why we ran and was it legitimate? Fed bossing. We will need to have some kind of slowdown in the labor market, but not a catastrophic one. Soft landing. Fed Bostic. Slow and steady chances in policy should reduce risk on a hard outcome. He was basically saying he supports a 25 basis point hike at the next meeting, but longer for higher. So the market is pricing in this longer for higher narrative, which is being concluded with the yields. Yields are basically saying higher for longer, but the market is kind of saying, okay, we really don't care because they're not listening to the full message. And I think you're going to get that at the summary of economic projections. I honestly think you have the ability to run up all the way to 412, 410 on the market, fill these gaps, set the A to B pattern. So let's just take a look at what if this is a massive A to B pattern here. That takes you up to 435. That's a one target. Or it's the flip side. We have, this is your A to B leg, B to C. Let's say we fill this gap here at 408, or even let's say let's say 408. We fill the gap and that's where we stop. Price target 382. Those are two very real scenarios that I could see happening. I do think this is going to be a bull trap here. That's just my perspective of it because you're not listening to the data. Inflation is coming back and the Fed is just trying to pivot to a narrative that, well, we really didn't say inflation was going down, or we'll see what Waller also had to say, which he spoke later today. Fed Bostic also said businesses say they're expecting to ratchet down the pace of wage increase, but still plan to add workers. This is bullish for the market because they're not going to have to do as much. You're going to have maybe subsiding inflation. I'm going to tell you that's BS because I work in a factory and I see wage spirals going out of nowhere. I see people getting higher and higher wages. It's very difficult to keep workers. This has not calmed down, and business can say one thing, but when the money hits the road, they're going to pay more for workers because they have to keep their business open and they're going to have to pay those wages. So it's going to continue that wage price spiral. It is appropriate to be cautious so that the Fed does enough to control inflation, but does not do more than we need to, kind of walking that line. I am firmly in the quarter point camp when it comes to the rate hike pace, and policy should begin to bite in the spring. Here's the problem, everybody. When we go to the FOMC page, do you see Bostic on any of these voting members? He's an alternative. He doesn't get to vote this year. So everything he's saying does not matter. Bullard can come out and say 13% federal funds rate. Guess what? He's not a voting member either. So he's not even an alternate. Bostic has some weight just because he's an alternate, but he's not the main voting member. So his opinion does not matter. But you see, a debate is underway about how much influence monetary policy is having on the current economy, blah, blah, blah. Risks are now roughly balanced, in my opinion. Well, you guys were claiming victory, so now risks are in your opinion. That's pretty bearish to me. But the market took and latched on to the news that it was bullish. Fed needs to remain resolute in fighting inflation, same thing. So he basically just went on to say, just reaffirming their beliefs. Now, I want to pivot to someone that is actually on the Federal Reserve voting chair, Fed Waller. Waller is on the board of governors, so he's always voting. His opinion matters a lot because he actually stays on for voting a lot. It may be the last month's data release were a blip, and coming data will show activity and inflation resuming their decline. So he's kind of saying, okay, we had a blip, and now we need to see if it confirms it. Similar to how I always say in the market, you have your trend, and now you need to confirm the trend. There is some reason for optimism, such as sharp deceleration and rent increases. So he's walking that fine line. He's trying to pull the message back, but also kind of say we're not done yet. The recent data underscores the view that the fight to bring inflation down to target will be slower and longer than we may have expected just a month or two ago. Higher for longer. You see this message that's getting put into their brains? Fed Waller, wages are growing faster than they have in decades, which may contribute to inflation remaining high. The recent data indicates that we have not made much progress on inflation as we thought. Higher for longer, higher for longer. Data shows that the labor market is tightening rather than loosening. Higher for longer. How many times do I have to say this, guys? Fed Waller, data last month challenged my view in January that the FOMC was making significant progress in moderating activity and reducing inflation. You see what's setting up here, guys? You're setting up for the most aggressive move of the Fed if you get another bad data point. And that data point is going to come either in the JOLTS job numbers, which is next week, Friday, or the CPI and PPI following that week. I think we're going to rally into all next week. I think you're going to have a push up to next week, and we're going to find the top. And then when we go into CPI on the 14th, that's going to be the murder. I think that's when all the bulls are going to get absolutely slaughtered, because inflation came back up without energy pushing it. Energy actually went down and inflation went up. That blew my mind. The PPI data blew my mind. I openly said I did not expect that. And then this is what everyone ignored. The Fed may need to raise rates beyond December's central tendency view of 5.1 to 5.4 in the incoming jobs, and inflation data does not pull back from stronger readings from January. So they raised their target. They raised their target again, possibly in March. We're going to get the summary of economic projections that we're going to basically see what they're going to say. There are some bumps along the way, but I assure you that the FOMC dual mandate objective will be met. So now then he goes into the Sanders spiel that I'll give. This is definitely something to be on the lookout for of where we could be going. Now, what I can say to all of you is make sure you have proper risk management, to look at the levels, just trade the levels, and it's as simple as that. If you break above here, go bullish. If you break below here, go bearish. If you're in between, sit on your hands, go enjoy the weekend, go have a drink, have fun. You don't need to trade the market every single day. I don't. I came in today and I had a nice position on my day. I basically came in, took profit, calculated the position, stayed in it for 3-4 days, had a nice end to my week. So you don't need to trade every single day. You just need to wait for that trade to come up. And right now with this kangaroo, as I've been calling when you're between all the moving averages, just sit on your hands and do nothing. Wait for a break above here, go bullish. You're probably going to start filling these gaps up here. I don't think once you get back above here, that'd be a fake out. I really don't. I think you would get continuation unless unforeseen events happen. Just wait till the close, buy your positions, then have it figure out itself then, and move on. Make it simple. Trading should be simple, guys. Don't try to overcomplicate it and make 5,000 things super complicated. And because you guys stayed to the end of the video, I'm going to give you a little tidbit of Lux Algo and what it's telling me. If we go to the S&P, what is it telling me? MACD nearly pinching together. RSI heading bullish. Oscillation bottomed out. Yeah, we're going higher, guys. NASDAQ, same story. Here, you have this divergence here on the daily. That's where I think we're going to come up, peak, probably hit this zone up here at 304 on the NASDAQ. S&P, I'm going to be saying 410 is where we're going to hit our head, which would align with how the NASDAQ would move. Come up here, hit your head on the divergence, and then we're going to see where we go from there. Definitely something to be on the lookout for there. With this divergence, this MACD, where it crosses, we could break this and completely invalidate the divergence, but I think you're going to have a momentary push up, then come back down. Especially on the weekly. The weekly is starting to pinch together. You could have an extension through here, which this takes a couple more weeks to pull together. S&P actually already crossed, which will cross back bullish, but it may converge and diverge afterwards. So we're gonna have to pay attention on the weekly time frame. Like I said, look at the weekly time frame. It will tell you way more than the daily and way more than hourly to understand the trend of the market. With that, guys, I hope you tune into our weekend deep dive. We're going to be discussing the close of Friday, which will determine our path forward. If you could kindly press the like button, it really helps the YouTube algorithm. We try to provide as much value to you guys as possible. And I usually do ticker request Fridays, but no one really put any tickers down. So go down in the comments section, throw a ticker down below. Let us review the ticker for you. Just let us know if it's specific, technical, or fundamental, or we'll try getting to both of them. With that, have a wonderful Friday. Remember, you don't have to trade every single day. Wait for the setup. This is the kangaroo. My opinion is to wait and see where we close on Friday, and then enjoy the weekend where you don't have to stress about it. With that, ladies and gentlemen, I bid you farewell, and I'll see you on the Weekend Deep Dive tomorrow.